Good evening, ladies and gentlemen. Today is the 6th of May, and today was the weekly expiry. And for an expiry, it was relatively mellow. But that having been said, at the same time, there was in between heavy underpricing of calls and call side expansion due to short covering that got triggered. But more or less, it was in line with the expectations. From a trading perspective, I took a very risk-off approach today, but managed to do quite all right, almost returned 4% on the capital that was used. And being an expiry and lately the nature of expiry and the nature of markets, I've just been a little risk-off. If you go back and see some of my older intraday videos when I was using smaller capital and more or less able to play with it easier and in a quicker manner, I would take relatively higher risk trades and generate higher returns percentage-wise. But something that is a massive misconception everyone has is that if you use more capital, it's easier to trade. Not at all. There are a whole load of problems that come with using a larger capital. And today I was trading with 1,050 lots of Nifty, and they relatively want to be risk off in a situation like that. So more or less the day went all right. Could have been better if a few of the adjustments were made a little bit ahead of time, probably having a little more faith in the view. But as I say always, view doesn't matter. It doesn't matter if you were right or wrong. It only matters whether you were able to execute it and whether it did well for you or not. So all that being said, I hope you had a good trading day. Overall, I think if any of you watched yesterday's market analysis video, and if you guys don't know about this, please do check out the post-market analysis video that Ravi is doing. It is the most comprehensive data-driven analysis of the market that was and what can be the expectations for the next day. I think this was perfectly an expiry that was in line with that view. And having said that, I hope you have some good takeaways from today's video. You can see that from the beginning till the end, the entire intention behind the trade was to not lose. And if we were gaining, then how do we lock in what we have gained to whatever extent possible? And towards the end, it worked out really well. So thank you so much for watching. I hope you had a good trading day, and I'll catch you tomorrow.
Want to meet like-minded traders and discuss option strategies, adjustments and more? Just type in Discuss Nifty in your Telegram search box and join the friendly trader community.
Good morning, ladies and gentlemen. I've just entered the positions for today. Time is 9:30. And in my first clip where I explained the analogy, my mic was not working. So yeah, at the entry we're half a point down, which is fine. More or less the idea for today is that this 14,500 range, which has acted as a support multiple times, should hold, which is why we've sold the 14,500 put. And at the same time, we've also spread our risk, but I'll come to that. And at the same time, this range of 14,700 and above is a very big resistance. And right now, whatever up moves we are seeing at different points is because of shorts getting covered. But at the same time, what I think will be very unsurmountable is the 14,800 level. So more or less the rough range is 14,500 to 14,800. Now, how is the position looking? Now, the position is keeping in mind that if I take the 14,500 and 14,700 800 strangle, then the 14,800 call is not going to balance the kind of gamma moves that we will see on the 14,500 put. Now, with that in mind, I have split my trade into roughly about 60% on the 14,500 and 14,750 range, because there's at least some meat in the 14,750 call, whereas there's absolutely no value in the 14,800 call. This will protect against moves and give me some time to adjust in case. And if there is some kind of a rapid short covering move, then I'll be able to get out of the 14,750 call and move to the 14,800 call, and also move up the 14,450 put to 14,500. If I was completely risk off, then my trade would be 14,450 and 14,800. But since there is some value in the 250 point strangle, which is trading at 27, 28 in that range, have decided to keep that. So for now, what we're going to look at is some kind of some of the major heavyweights are weak. So even the up move is not coming from strong names. It's not your TCS, Reliance, Infi, which are carrying the market up. It's not even HDFC or HDFC Bank. Yeah, HDFC little bit, but not much from HDFC Bank. So some of the big names are weak, so not expecting some kind of a massive up move. But at the same time, if these calls start to expand to something like 18, 19, then I will be getting out of them and moving them all to 14,800. So for now, we're just going to let the noise in the market play out. We need a test of 14,700 before we do anything to excessively manage the risk on the 14,750 calls, right? So that being the case, right now, this is a relatively very neutral position. The risk is definitely on the call side when the calls start to explode with some kind of a short covering move. For now, open interest data is not really going to give us much. Won't be updated properly till about 10 o'clock. So this is a fairly balanced position. We'll continue to hold on to this for now. I'll keep you posted. The time is 9:33. Okay, a slight up move coming from the fact that we made a dip and then big up move on Bank Nifty and other stocks. So regardless, there should be a resistance here in this range. 33,000 should act as a resistance, and I'm not going to get too quick to risk manage these calls. What I've done is I've squared off the 14,450 put that is not of our concern right now and moved it to the 14,500 put. This is not particularly great pricing, but we have all our puts at 14,500 and we have 60% of our calls at 14,750 and 40% of them at 14,800. So a down move should be fine. A continued up move also should be more or less all right. These calls, if they really do start expanding, we make a break over 14,700, hold over 14,700. At that point, I will have to move them up. The thing is, we have to bear some of the pain in case there is an up move. There's just no other way of doing it. You can't sit on an expiry strangle and not hope that the market doesn't move at all, not more than 50 points. So yeah, this is bound to be there, and yeah, can't do too much about it. So the idea is we moved up our puts, so we have considerable credit on the put side, and we are not rolling away our calls yet. We're going to wait, because what is happening as we are heading to 14,700, it is the market is making an assumption that we're going to make that break. We are going against that. That's why when these call side IV spikes, we're still holding on to the calls. So time is 9:40, and so far position continues to look all right. Okay, one more change made. 14,750 call exited just because I don't want to deal with the gamma expansion that's going to happen in case we make a break. So the whole market is obviously underpricing calls again. We gapped up, got sold into, tested 14,700, which should act as a resistance place from where we broke down. And now we're testing again, and I do not want to have to deal with the fact that these which are trading at 20 might spike up to 30 in a matter of seconds, just for a few seconds, if even. So have squared off all the 14,750 calls and moved them all to 14,800. Now a reversal will kind of annoy us because these calls will not lose as much value as these puts will gain. So in case there is a reversal, the idea will be to square off the puts also and move them lower to 14,450 or even 14,400, because the idea is, I mean, I do not want to expose myself to any kind of directional move. At any point, I want to be from the put side at least 150 points away, and from the call side at least 100 points away. That's going to be the idea. It's okay if we get bad deals. On an up move, we're rolling away the calls. On the down move, we're rolling away the puts. We're going to get a bad deal, but that's not a problem. The idea is to not lose money, and even if we don't cash out a big expiry, that's perfectly fine. Plan is to not lose money. So moved away the calls, because at this point calls are being underpriced. I mean, you've got a whole expiry day left to go. We're trading at 14,700 at the brink of a breakout, can trigger a short covering, and 50 point away calls are trading at 20. So yeah, not worth it. So we'll keep you posted. Time is 9:50. Most likely there's not going to be many changes to this position from here. Currently this strangle is trading at, let's say, something like 16, 17, and that's more or less what we're going for today. So 16, 17 points, more than happy to take that. And in case we have to reduce it because the puts start to expand, then we will also, but we'll wait. We'll wait for a clear test of 14,650 and a down move from there to really consider doing anything to the puts. Also, just to add, since our target for the day is something like 16, 17 points, the max stop loss we can take is something like a 10-point loss. So what will we do? Generally, that changes the risk reward equation. That'll be slightly higher than 2% on the capital used, but also the return will be 3.5% on the capital used. So that's more or less how you work. On expiry day, your risk reward will always be higher. That's the nature of markets. So keep you posted. Time is 9:52. Okay, slight issue with the recording, but basically what I had done at some point, not when the puts were bleeding, but just to deal with the fact that puts had lost a lot of value. These were trading at 10. I bought them back and I moved them to 14,450, and all of my calls were at 14,800. We started to see a down move, and more or less what is happening here is there's a lot of there should be a good amount of support in this congestion that is there towards 14,600. There's also a lot of 14,600 put writing, so yeah, relatively higher likelihood of us heading up from here than heading lower. Our position is all right to deal with that. Half the calls have been moved to 14,750, and all of the puts are at 14,450. So we have a good amount of distance, 175 points on the put side, and half our calls are at 14,750, which is 125 points away. So that has enough credit in it to protect us against some kind of a down move, give us enough time to react. The idea will be to see a test of 14,600, and then if we break 14,600, then move all the calls to 14,750. So more or less that's the plan. Everything is looking all right. Nifty IT is flat. Reliance is holding on to the 1900 mark. HDFC has seen some amount of up move, and apart from that, Bank Nifty as well, quite flat, took support, made down move, took support at 32,650, that range. So yeah, for now this position is fine as it is. In case we start making a down move, we'll move down these calls to 14,750. In case we start making an up move and start heading once again towards 14,700, then we will book these calls and move them back up to 14,800. So yeah, that's the idea. We are up half a point or something. That's because we've been very careful risk managing each side. This question always comes up that if we just made a strangle and left it exactly as it is, it would have done perfectly fine. That's not my idea. My idea is not to enter a position and just let it sit and either make money or lose money. I will work very hard to not lose money. Even if I'm not making money, it's fine. I will take exactly bad trades in order to sell calls into a down market and sell puts into an up move. I will do that. I will get bad deals, but the idea is because I do not want to lose any money. And time is almost 11 o'clock. Just taking a look at the open interest. So right now 14,800 seems to be a ceiling and just an impossibility, most likely. And 14,500 on the downside seems to be some sort of ceiling. So 14,600 put also picking up through the day shows you that there is strength. So 14,600, 14,500. So 14,500 put can be taken as the downside ceiling, more or less the same rate that we were working with in the morning. Now 2 hours have elapsed, and only one change has been done because there's hardly any value in the 14,800 call. Have moved down all the calls to 14,750, and because there is also not much value in the 14,450 put, have moved all the puts up to 14,500 because it seems like the likely range. Now yes, the same trade could have been taken earlier with much better premiums, but you had the entire first 1.5 hour of volatility to factor in. So that being the case, this is now trading at something like 19, and more or less from here I might have to make adjustments if we start heading to 14,700 on the downside or start breaking 14,600 on 14,700 on the upside and 14,600 on the downside. But overall, currently we're going to still work with the same idea that the maximum stop loss that we'll take for the day is 10 points. You know, if you watch some of my older videos where I managed to do like 10% on expiries, that has been mainly due to the fact that my sizing was much smaller, and 10% on a 1 crore capital is like same as 3.3% on a 3 crore capital with much lesser headache. So your trading will have to vary with the kind of capital you're managing. It definitely, especially when you're taking relatively high risk trade, and no matter what you say, trading on an expiry is a high risk trade. So yeah, this is more or less the idea. I'm not going to break my head too much as long as we don't test 14,700 on the upside and 14,600 on the downside. So far the entire day we've been in that range, and as long as we're in that range, not going to make any changes. In case we start breaking range, then I will start to have to take in additional credit on the losing side, on the winning side. And so during this up move, there were calls being written at 14,700. So I did not do anything to adjust the risk on the upside. Now we've had this quick sell-off. So IT was looking really strong, and that kind of capped off. And now we're seeing red candles both on Bank Nifty and Reliance. What this is doing is slightly expanding the 14,500 put, but I'm more concerned about what is happening with the 14,600 put. So if this starts to get unwound, then it is something worth being a little concerned about. Right now, I'm not too concerned about this. The call has lost a lot of value. Yes, so it's not going to protect too much further, but I need a test of 14,600 and some kind of move below 14,600 before even considering the idea of risking off on the put side. So what will happen if we test 14,600 and head below 14,600? Half the puts will be squared off and move to 14,450. In case we firmly start heading below 1,600, then I will start to have to aggressively take off risk on the put side, but not of consideration at this point. So I'll just add in like a quick thing in terms of how to think of probabilities, right? Let's take a look at this. How to calculate the probability of what is the, if I were to ask somebody right now, what is the chance that we head below 14,500 and head all the way till 14,450? So what is the chance? Can somebody look at it? They'll say you're not looking at the Greeks and whatnot. I'm asking you a very simple question. 14,500 put is trading at 8.7. Okay. 14,450 put is trading at 4.4. What is the probability that we expire at? Right now, with the current market and given all data, what is the probability that the market is giving to an expiry at 14,450? Very simple, I'll put. What is the credit that you will get if you sell the 14,500 put and buy the 14,450 put? It will be 4 rupees. 4 rupees, right? Now, what is the debit? Essentially, what will you be paying if you are buying the 14,500 put and selling the 14,450 put? Right? You're creating a bear put spread. You're paying 4 rupees. What is the return going to be if you're right? It's going to be roughly, let's say, 46 rupees. 46 rupees means your money is going to turn how many times? It's going to basically become 11 times. So the chance of that situation happening should be, naturally, if you think market is pricing in risk properly, it should be 1 in 11. If you're going to get 11 times your money, provided the risk reward is priced properly, then there is 1 in 11% chance of that happening. So you can say almost 92%, with 92% certainty that 14,500 put is going to hold by looking at how is the risk being priced. Now, do you need a calculator to tell you that, or can you get that from the pricing itself? So that's basically how the market works. Market works on probabilities, right? So it works on, okay, what is this probability of this happening? Similarly, you look at the 14,750 call and 14,800 call. What is the probability of that happening? There also you're getting something like 4 points. So there is 8% chance, 1 in 11 chance that these calls actually end up being in the money by 50 points. But that is there in both. So you have 8% on one side, 8% on the other side. And obviously, as somebody who is taking on this risk, you're not going to sit in the risk the whole time. As the market moves, as variable changes, as data becomes different, as different factors, as opinions of people change. Right now, this is how people are pricing it. That might change the next second, next candle it might change. But right now, that's how the market is looking at it. So just wanted to add that in there. I think it's something that should make sense to a lot of people. The time is 11:43, and so far the spread is very comfortable all day. We have held the 14,600 and 14,700 range, and a lot of positions building up around 14,650. 14,650 would be the most likely expiry spot. All that being said, currently we are sitting on a credit of something like 14 points. So yeah, 14 points is still a lot, and our position sizing, obviously being an expiry because of the kind of hedges we can buy, is on steroids. 14 points will work out a very, very good return on this sizing. And yeah, I'm not going to do any changes to this as long as we are, as mentioned before, holding the same range. One more thing to add is I will potentially, as we are heading into the minutes of averaging is still a long way away, so we've got 3 hours to go for averaging. As we start heading there, I will probably move in and take in additional credit on both sides and just try to close in the spread as we head towards averaging. Okay, slight issue now. Out of nowhere, there seems to be strength in Reliance, and it's really pushing us up, and it's also leading to some of the calls getting covered. It's not particularly an issue for us because calls are very far away, 90 points away right now. But at the same time, if volumes start to pick up in Reliance and there is some kind of a big move, like something to pulling it all the way till 1950 or higher, then that might start to be a problem. And if something like Bank Nifty and TCS and Nifty start to join in on that, that's going to be a problem. So that's potentially looking at what could be a problem. But even then, I think 14,750 should be more or less comfortable. Now, what I will do is I'm going to wait. In this case, some early shots might start covering. I'm more concerned about what's happening with the 14,700 call. The 14,700 call right now, with 3.5 hours left to go, is trading at 21.22, and it's basically 38 points out the money. So I wouldn't say there is too much value being placed on it. At the same time, it could also lead to like a massive short covering situation also. So it's something to be aware of at this point, be wary of, and react to quickly in case it does happen. I don't see it to be likely, but something to just note. Okay, so this continues to play out. Reliance continues to remain strong now. IT is joined in as well. Bank Nifty was somewhere around here, made a slight up move, but more or less is halted. This is pulling the index up, and this is going to start freaking out the call side. But one thing that's clearly evident is the calls are not reacting to it in price. So definitely they are not getting covered at this point. The market believes there is enough strength in those who have sold at 14,700 and above that they are not covering, which is a good and bad thing, which can mean that the level most likely will get protected. But if it's not protected, then it can also mean that these will explode very quickly, right? So that's something to be aware of. And in the meantime, these puts have come down considerably in price. Now, one particular adjustment that can be done in case these start to explode is move up the puts to 14,550, but there's really not too much value in that. And if there's a rejection, these will increase by 30%, 5 points in a matter of no time. We have like a quick rejection. So not doing anything is now, but just being very well aware of how the market is positioned. It's like, okay, the 14,700 calls are not getting covered because the intent is to protect them. But at the same time, if there is something unexpected, like Bank Nifty heading to 33,000, which is a realistic possibility by all standards, then yeah, the calls are going to explode. So regardless, the time is 12 o'clock and more or less sitting quite comfortable and quite a bit positive. So just going to wait and see now what happens with the call side situation. If the calls start to explode, then yeah, I'm going to exit the call side and then probably enter by selling the 14,800 call if they start to explode. I don't want to take input side right now because yeah, we've seen how this goes before. I would rather risk off than take an additional risk during this trading day. Okay, so basically exactly as what we would like. We had these calls starting to get covered. I mean, it still sits in that, okay, there's resistance here, there's clearly resistance here, a lot of call writing at 14,700. It should be protected, but I cannot just sit on calls expanding into oblivion. These will go from 15, 20. This will double in a matter of no time. In 20 points, these will double. So to just be hands off when that happens, have squared it off and moved everything to 14,800 call. Now that should more or less be a ceiling for the day. So we're going to just stick to the ceilings for now. So 14,800 is where we're back at. And yeah, for now, our puts remain at 14,500 as well. Initially, I did consider moving to the 14,550 put, but then there's just not much value in it. So why? So more or less sitting on a credit of 7.5 points, and the hedges are going to cost something like 1.25. Now towards the end, there might be an opportunity to move in closer and take in some additional credit, but for now, we're just going to work with this. We'll keep you posted. This is also a way of protecting profits. You know, you're already up. If you're already up for the day, considerable amount, why do you want to put that on the table? So you're risking off as the day goes on until averaging time is a way of saying, okay, I'm just going to lock in this much. Okay, so Nifty IT is going berserk with slight support from Bank Nifty. Basically heading to no man's land, massive up move on the IT sector. And what that has done is it's now absolutely blowing up these calls. So it's a good idea to risk off. And you can see this, like when just this was not so far away, just 25 points ago, this was trading at 23. Like when we were at 685, that range, this is trading at 23. This doubled, because you don't cover shorts until you're like, oh, it's going to get protected, it's going to get protected, and it doesn't. And that's what happens. So anyway, good call to risk off on the call side, and now have, because you've seen this break actually happen, these calls have expanded, have to take in some put side credit, so have moved up the puts to 14,550. And yeah, we're still comfortable. A lot of this is fear from calls getting covered. I would still be of the opinion that 14,800 is an absolute ceiling, and that we should not see 14,800 even get tested. But I could be absolutely wrong, which is why I have to take in additional put side credit. Now we'll wait and see. Right now we've held above 14,700 for 2 candles. If this continues, then we will increase our bullish bias. So 2 candles, if we hold here or make another 20-point move from here, so 14, basically heading to 14,750. If we start heading up, we'll be taking in additional put side credit by moving the puts to 14,600. So we'll wait for that, not in a rush to do that as of yet. But yeah, IT absolutely going berserk. Nothing else. So anyway, that being the case, we'll keep you posted. Time is 1 o'clock. We have 2 hours left to go for averaging, and the short covering has been triggered. Now it'll be interesting to see till what extent it could possibly go. But yeah, tough to say. Okay, one more thing that I've done is I've moved up half the quantity of puts from 14,550 to 14,600 to take in a little more put side credit. Yeah, it's the worst possible time to do it, but it can't now sit on these calls potentially expanding. I don't know till where the short covering goes. And I've tried to do this on a slight dip. Basically, IT is what is strong, and IT, I don't know, during expiries always does weird things. Like, I think this is, in my expiry videos, this is not the first time I'm mentioning. It's easily the 5th time I'm mentioning that IT does weird things on expiry day. Right now, IT is on an upward trajectory, shots are getting covered, and Bank Nifty potentially could now trigger a situation where all the calls written at 33,000 start to cover, and if that really happens, then spot heading to 14,800 is definitely a situation. But right now, Bank Nifty is not really participating in the up move, and neither is Reliance. So that is one reason I'm not moved all of the puts up to 14,600. So yeah, for now, moved up half the puts. We'll see what happens, and from there take any other action that's necessary. Okay, fair enough. So rejection and crash in call prices, that's fine. Whatever half of the puts I had moved up to 14,600, I closed them, and I moved them at roughly about 6.2 average. I closed them at something like 7.5, and I have rolled them back down to 14,550. At this point, I don't see any more adjustments from here. We've got 1.5 hours left to go for averaging, and I'm not going to do anything. I'm just gonna, like, this is trading at 5.5. If it expands in whatever situation to 8, I'm going to just start cutting the losing side and probably taking 1 point credit type situation. So this particular position after here will be only risked off if it goes to 8 or higher, and if it holds the range, then we might take in additional credit, but only towards the absolute end while we're heading into the averaging period. We'll keep you posted. Currently at this point up by a little more than 1.25%, and yeah, the idea is take home whatever can be taken home. It's still a very, very good return. Okay, just taking a look at the OI. What's happening is we're seeing unwinding of 14,600 and 14,500 put, and people might wonder why is there unwinding. It's because this, you see, we're having 14,700 put now heading up. A lot of short straddles being built at 14,700. A decent amount of premium also available. So now 14,700 seems to be like the preferred expiry spot, and high possibility of 14,650 also. So 14,650, 14,700 would be the ideal expiry. Our position is now down to the rupees. So currently there is not a lot left here. 3 rupees 50 paisa, which is still a good amount, and I don't want to at this point take in additional credit, so I will not. What I'll wait and do is I will wait till about 3 o'clock, just as we hit 3 o'clock, and at 3 o'clock, once averaging starts, one of two things will happen. Either premiums will crash, the at the money straddle will lose like 50% of its value in a matter of a minute, or we'll see a big move. One of the two things will happen. So at that point, whichever side, if there is no move, then I will move in by 50 or even 100 points on both of them. 50 on the call side and maybe 100 on the put side. At that point is a consideration. If not, then if there is absolutely a directional move, then I will adjust from the other side. So if there is a down move at that point, I'll roll down the calls. If there's an up move, I'll roll up the puts. Overall, now the idea is we're up close to at 6 lakhs will be up 2%. We plan to take home 1.5% from here regardless of the outcome. So overall, decent expiry. My just approach to this expiry in the next few expiries will be to do something on the similar lines of this. You do very risk off sort of trades, and at the end of the day walk away with 2%, 3%. That is a very, very good return. The reason I'm doing this is previously, when I was handling a low level of capital, I knew that even in my worst possible drawdown, I would not burn more than 1/3 of what the market has given me over a period of time. Whereas with larger sizing, that's not the case. Trading with 1,000+ lots, that's not the case, and a drawdown could be quite bad. And until I build up my capital a little bit and I'm comfortable trading, like very comfortable, it takes some time. It's not going to be like you were uncomfortable yesterday, today you're going to be comfortable. Until that happens, I'm going to do very risk off trades and constantly focus on not losing money and approach it that way. It's not a lack of confidence per se, but I don't want to get overconfident also. So we'll work with lower risk rewards and see how that goes. Anyway, we've got 55 minutes to go for averaging, so a long way. Until then, more or less going to sit on this same spread unless there's some kind of move. Okay, in the meantime, just to review some of the positional trades. HDFC Bank is doing good. High IV down move. We made a bullish triangle. It's doing all right. Nothing to do there. IndusInd Bank continues to stay in our range. And basically, at this point, the premiums are still good. So you can think of this as trailing stop loss. I'm trailing stop loss on this by about 5 points. So since the premiums are good, it makes sense to just hold on to this position for now. And we'll continue to stay in range. Reliance, the different expiry triangle is also doing well. The IV spike that we shorted on the down move, and this is a nearer expiry call. That's also doing well. TCS as well made a bullish spread. Now the call is starting to bleed, so this is starting to become a problem. What I will do to this is wait and see. Today expiry move, IT is making some kind of big move, so I won't do anything to this right away. We'll potentially look at taking some more put side credit on TCS if the up move on IT sustains. So yeah, I had shorted this at 69, it's gone to 23 now, shorted this at 34. So clearly in a bullish triangle, up move benefits you, but then if you hold on to it perpetually, now if we wait for this to go upwards of 50, that's going to be a problem. But I'm anticipating that a lot of the up move on IT is expiry related. Bandhan Bank wasn't doing so well. We were down some 15,000 or so on Bandhan Bank. I just exited the position instead of doing any adjustments. It's a low quality company. You never know what happens. I could have adjusted this by creating an iron fly at 300, but decided against it because really the premiums are not that great. And I mean, it's been barely a week, not even a week, like 3 trading days since I took this trade, and it's already doing badly. Now trying to fight a losing trade right off the bat is, I don't know, it's arguable. If there's a good opportunity, good premiums, you can always try that. But since it's down, might as well take the exit. So took the exit on Bandhan Bank. Yeah, the range continues to hold. A lot of positions building up around 14,700. Might be a 14,700 picture perfect type expiry situation. If that's the case, then we should be getting good amount of more credit into the averaging period. Okay, so what I've done now is so a slight dip from 14,700, which seems to be the ideal expiry spot. Slight dip, and I have used that dip to switch all my puts up to 14,600. So got at a pretty decent price, something averaging like 4, so around the range of 4. And yeah, I also have moved down the calls by 50 points to 14,750 because there's hardly any premium left now. Now this is trading at something like 5, and once again we can more or less have to trail stop loss or adjust risk based on another 2.5 points from here, 2.5 to 3. So if this starts looking at something like 7, then that's a point for risk management. So basically towards the end, see, if you do it earlier you get more premium, but you also have more time to deal with the risk, right? So about 28 minutes to go for averaging, looking very poised to a 14,700 expiry, or at least between 14,650 and 14,700, and that is played well by the 14,600 put and 14,750 call. We're keeping an additional 50 points in either direction of what we think is the most likely expiry situation. Now there's another aspect to this also. Now just as we hit averaging, that gives us another potential 100 points that we can close in on to end with a 50 point triangle towards the end. We're in good profit, so over 2%, and we have every intention of taking that home. So in case things start going wrong, plan B to get out very fast. There is how much left in this? So there's 4.7 points in credit that we have, should be OTM, and about 45 paisa in hedging costs. Okay, 20 minutes to go for averaging. Have moved all the puts up to 14,650. Now we're just 100 points range of the spot and trading at something like 7. So once again, stop loss on 7 would be 3.5, so we cannot take more than 3.5 points of damage. So basically had to aggressively move up the puts quite quickly because these calls are starting to expand. We're seeing some last minute up move coming from Bank, Nifty and Reliance. I am still expecting a picture perfect 14,700 expiry. 9 minutes to go to averaging, and what is happening now is if you look at the 14,700 short straddle, averaging is not even begun, it's already trading under 25. So it's like the market is fixated on the expiry being 14,800. That's how convinced the market is. It's not even anticipating. I mean, the put is even in the money by 8 points and it's trading at 15. So the extrinsic value given to the put over the period of the next 8 minutes and the 30 minutes after that into averaging is what? Is $9. Very low premiums. It's almost like it has to certainly expire there. Like that's what the market is saying. The market is saying the guys who are buying calls and the guys who are buying options as well as selling options, like there is such a high certainty of it being it's just if you buy the set for 25, you just need a 15 point down move and you're profitable. You have 40 minutes and you can book that at any point even. So interesting, market is heavily pricing in that expiry, and that being the case, we are now sitting on the same triangle, which is trading at 3.3. Stop loss is 5, so we just keep trailing in, and yeah, very good amount of profit from having a relatively very risk off kind of a day. We're now looking at upwards of 3%, and more or less whatever is left will benefit us quite a bit. There's still 3 points change left, so we're going to continue to hold and just trail the stop loss. Also remember one thing, mark to market is not your profit. Never assume until you get up off the chair, until the day is done, until you're logged out, it's not done. The day is never done. It's not over till it's over. And never look at mark to market and consider that your profit, because then you'll feel very bad if you lose from there. You'll be like, I was up at, hindsight is 2020. Never look back and say I could have done this. Okay, averaging has started, and yeah, not a lot happening. Looks like we're gonna most likely spend some time below 14,700 and then probably make a slight up move, spend some time above 14,700 and try as much as possible to make 14,700 literally worthless. So that's exactly what's going to happen, most likely. That's the most likely scenario. There's no directional move, so it means I can't take in any additional credit. This is now trading at 2 points. 2 points doesn't seem like a lot. 2 points is a lot. It's a massive amount of points. From profitability perspective, 2 points right now is going to work out something like 0.5%, which is huge. So far averaging just started, nothing happened. These are slowly going to go to zero, but in case they don't, 3.5 points is the exit. There's no way we're getting burnt on 60 paisa or 90 paisa expanding. It's not going to happen. It's going to be picture perfect 14,700 finish. That's going to be the case. Looks like overall by the end of it we will be up something like, there is how much left here, 1.5 points, so something like 12 lakhs change, and that would be a 4% return, and a 4% return on a day when you want it to be very risk off. So it's a good enough outcome. We'll keep you posted. We've got a while to go into averaging, but at this point, probabilistically speaking, it's 99.9% that this goes to zero. I went over how to get the probability, so you can look through that as well. There'll be people sitting there with a timer averaging the Nifty also. So yeah, very high probability of this going to zero, but at the same time we do have a stop loss also, just in case it doesn't. So okay, the spread is now trading at 40 pice, 35 pice, like that. And see, here's the thing. If I get auto squared off, right? So this is 1056 lots, and roughly it will take 16 orders per leg to execute, and you so 16 into 4, so 3200. If you take 50 rupees per auto square of logic. Now 5 paisa on this equates to about let's say 4,000, 80,000. So even 5 paisa of DK is more valuable than the 50 rupees charge that you will get penalized for auto square off, which is why I mean, this is going to end up getting bought back for like 15 paisa or 20 paisa max. So that being the case, why? Now look at how averaging working. This is trading at 30 paisa, but for this to make any money at all, we are almost, let's say 13 minutes in, but 15 minutes in to averaging, right? We need to spend almost 10 minutes at 14,780. 780 for 15 minutes, and then there's some chance that this, we need to immediately jump up 50 points from here, and the next 15 minutes we should never spend any time below that, and only then this will have any value. That is how this, I mean, because majority of the average has been spent towards 14,700 and below. What is the midway mark between 14,700 and 14,750? So it's going to go to zero. It's no doubt about it, it's going to go to zero. Another option sometime down the line would have been to move the puts here to 14,700. But at this point, just, I mean, what is there in it is just going to be a headache of a situation to just shift up. So instead, we're just going to let it be as is, and we'll try to get at least another 15 paisa. So for the day, should be closing just below 12 lakhs. Okay, one more thing to add is how to know what is Nifty average currently exactly. Look at any option that's in the money. That will tell you exactly how much Nifty is in the money by. So 14,700, right? So I don't know if you can see this. Yeah. So 14,700 call is trading at 24. Spot is trading at 14,736, whereas the average is actually 14,724. How do you know this? Because no one is an idiot to pay 1 pice more than what it's worth. I'll show you how to check for sure. So you look at the Nifty 14,750 put option. Yeah, Nifty 14,750 put option. Yeah, you add these two, you'll get exactly 50. You add these two at any point of time except for a few paisa, which is the same value as between 14,750 call and 14,700 put. You will find that these will add to a perfect 50. Right now the average is moving up, so the average is 14,725 now. So that's why the call is getting worth that much. So generally, people with massive infrastructure will take advantage if there is any discrepancy between. They'll have supercomputers computing what is the average Nifty price right now, and if there is any change here between what will be the closing settlement of Nifty. And if you don't know what averaging is, I've covered it in the FAQ, so please do check that out, how averaging will work, but you will not find any discrepancy. So the average continues to remain 14,725.6 at this point. We should be getting auto squared off in a matter of a few seconds. Most likely we'll be buying this back at 15 or 20 pice, one of the two. There will not be anyone I can sell this to. There'll be no buyers for this. These will get executed, it's not a problem, but since these are OTM and completely worthless, there's going to be absolutely nobody. So yeah, there we go, the orders start executing, and yeah, no buyers for this for us to sell. All put together, close the day 11.71 in the plus, and that's the day. Good day and relatively alright market as well. Thank you so much for watching. I hope you had a good expiry, and I'll see you tomorrow.
Thank you for watching. Please post any questions you have in the comment section. Also, do not forget to like and share the video and subscribe to the channel. To find us on Twitter, Telegram and Facebook, use the username NiftyBN. Also, we post some of our trades to the community tab, so do not forget to check that from time to time.